You are now tuned in to the Plaza Advisors podcast.
Shopping center, multiple leases, multiple tenants. What's the average timeline? Retail investments are purchased based upon a stream of cash flow from tenants, from credit tenants, the value of which is in the tenants' leases, the stream of cash flow.
Hi, welcome to our commercial real estate podcast. This is JEFF-DERVECH of Plaza Advisors here. I appreciate you listening in with us. Today we have a great show. We will be discussing one of the most important dynamics surrounding the shopping center investment, retail leasing. It's all about the cash flow. From market studies during due diligence prior to acquisition, reinvestment into existing shopping center assets to create and unlock new value, and strategies for keeping operating expenses down. We're going to discuss trends and changes we're currently seeing in the space, view on lease guarantees from the landlord's point of view, and the new versus old mindset on use restrictions. Our guest today is Marc Elias with Regency Centers. Marc currently serves in a senior leasing role for Regency. He's responsible for their West and Central Florida shopping center portfolio, encompassing over 29 properties. Regency Centers is a real estate investments trust based in Jacksonville, Florida, and is one of the largest operators of shopping center assets, currently owning 422 properties, comprising over 57 million square feet of space. The company owns neighborhood and community shopping centers, primarily grocery-anchored product throughout the country. Marc graduated from Florida Atlantic University, is active in the International Council of Shopping Centers, and currently resides in Tampa, Florida. Marc, thanks for being with us today.
Thanks for having me, Jeff.
Absolutely. It's our pleasure to have you. Marc, if you would, please talk and give some background on what you do in your position with Regency, day-to-day functions, and how you manage your time with all the shopping center assets and gross leasable area that you're responsible for.
Sure. First, it starts with lots of coffee, but I handle about 33 assets, as you mentioned, West Florida. So I go from Naples and territory goes up to about Jacksonville. Day to day, obviously, organization's key. It's all about pipeline in this business and, constantly creating more opportunity, sustainable opportunity too. So being organized, completing a pipeline of strong tenants, making sure you're keeping that loaded. And obviously when you're signing good deals with good tenants, you're avoiding a lot of turnover, which allows you to focus on other properties and continue to move forward. So, 33 assets, it's a lot, but again, kind of our focus is finding high quality retail. And in turn, we're able to keep high occupancy. So we're at 96% occupancy in Florida right now, which is pretty good.
Yeah.
So right now we're, looking at repurposing and finding ways to fill kind of elbow spaces, tough spaces, things like that. But day to day is looking at renewals. Anybody that's coming up in the next 6 to 8 months.
Let me ask you, how do you focus on that? So 33 centers. Just say, for instance, every center's got 20 tenants. That's a couple hundred tenants that you got to manage. The different dates that they're coming up, the renewals. Like, what type of systems do you have in place to kind of look at that to give you kind of a tickler to, hey, listen, when you start having conversation with this tenant, I'm sure you're fully integrated in your assets and.
Yep. So we have pipeline reports that come out 6 months prior to lease expiration. So that kind of gives us a red, hey, look, this folks coming up, need to reach out to them. Now, a lot of tenants, obviously we're signing 5 and 10 year leases for the most part. So a lot of these things, you're looking 5 years out. And then a lot of tenants have options too. If you sign a 10-year initial lease, we generally grant 2 5-year options to match the initial term.
Sure.
So I may sign a deal tomorrow and not have to do something for 20 years on that space.
Right.
And again, being at 96% occupancy with most of those being long-term deals, a lot of this is just kind of looking out. But, we're constantly having leases expire naturally. And, we, again, try to look out about 6 months. So we do have internal pipeline reports that come out that say, look, this tenant's coming up the next 6 months. Do they have an option? Do they not? Have they passed their option notification date? Things like that. It also, rent is a factor of sales. So these reports also let us know the strength of the tenant, how they're doing. How are their sales? They've been declining. And, if you have an issue, it allows you to reach out to a tenant and ultimately determine long-term, is their business sustainable for the shopping center? Is this something that we're looking to renew? Is the tenant looking to renew? Does it, we always want to make sure we're setting folks up for success. And sometimes you do want to renew tenants, and for multiple reasons, sometimes, ultimately we have to move on. Yeah,
like you said. So have their sales increased? Have they decreased? What's their the rent to sales ratio? Is it healthy? Is it a healthy ratio? Things of that nature. Just on the personal side, we talk about, and we're involved in some book clubs and things like that, and we talk about organization and how it's so key to be efficient and productive and things of that nature. What do you do personally to prepare for your weeks and things of that nature? Myself, every Sunday I sit down for about an hour and kind of try and map out my week, at least accomplish Monday through Friday, kind of one key priority that I want to accomplish that day, and then the night before kind of determining maybe like 3 key items I want to accomplish, the following day. Do you do anything similar to that to kind of, because there's a lot going on, a lot of balls to juggle in what you do?
Sure. So new deals is my primary focus. So I'll spend, I call them my 5 elephants. Every day I come up with 5 elephants that I have to kill before I move on to anything else. And that's generally the new deals that I'm working that have critical issues. Maybe we're close to the finish line. We have to get a couple items done, a couple clarification points, legal calls, things like that. But no, I pick my 5 elephants every morning and I go and make sure I attack those first before I move on to anything else. And renewals, I pick a day. So it's generally every Thursday. I come in and I'm focused for 4 to 6 hours on renewals, reaching out to tenants. A lot of times it's sending an email with no response. A lot of times you call tenants and you do get an immediate response, but generally it takes some time.
Sure.
So if I'm reaching out on Thursday, I get responses on Friday. That tees me up to be able to send out proposals for the renewals and then again follow up the following Thursday. But Monday through Wednesday, my primary focus is on new deals.
Your elephants, I like that. I call it frogs. Every day I look at, I need to eat that frog. Like, what is the one thing that I need to accomplish? It's a big priority that I just need to conquer first. And it's a book that I read actually called Eat That Frog. If you haven't read it, it's a great book. That's awesome, man. I love that. And so just, want to talk about, the process and review analysis of a shopping center acquisition. Can you walk us through your process and review analysis of what your group looks at in a new shopping center acquisition that maybe your company is considering and when they might pull you in? Because I'm assuming that they seek out your opinion early out in the process in order to kind of get your viewpoint from a retail leasing standpoint, the rents, the markets, the tenants, the asset, everything. Because at the end of the day, they're going to hand that property to you and that's going to be your baby.
Sure. So really, I just look at the leasing side. I look at rents comparing to market, look for upside potential, look at tenants' performance from a sales standpoint, see how they're doing, see whether or not, we're thinking we're going to be turning over space in the near future. Again, it's all to look for upside, the potential sale. We are a REIT, so how we're evaluated is rent growth. So when we go into an asset, we want to make sure that we have some potential to grow those rents long term. And, maybe as an immediate opportunity, for the most part, we don't look for super value add type opportunities. We like stable shopping centers with strong tenants. But kind of what we talked about earlier, leases are signed for 5, 10, with 2 5-year options, 1 5-year option, whatever it is. So a lot of times, trends, you might have signed a retailer today that, in 6 years isn't doing all that great.
Sure.
Well, we're 6 years into that 10-year term. We see some potential to potentially grow rents based on the market rate that was signed 6 years ago and the performance of the tenant today. So, really it's just turning over all the stones. How are tenants doing? How are those rents compared to market? And what can we do long term to try to grow those rents?
And so that's that specific asset. But, when you look at the asset in the marketplace, it comes down to the other competing properties and what they're doing and talking, this business is all about relationships.
Sure.
If you're looking at a property, say in Jupiter, or you're down in Naples or whatever, and there's competing properties, and the other, everyone in the business, so the retail leasing business. How valuable is it to be able to leverage on those relationships, to be able to call on that asset, talk to the leasing representative there, and kind of talk through where they're at on deals, what they're doing, what type of rental rates, and then doing market studies per se.
Sure. Well, fortunately, we're in most of the markets that we're looking to transact in. So where we're looking for new centers, we've got experience in those markets. But to your point, knowing what the landlord did across the street, not what they're quoting or what they're saying market is, but actually digging into the real deals. How much TI did you have to give? How much landlord work did you have to do? How real is that rent number? So understanding, what the market's doing and how they're performing in actuality, as opposed to what's on paper, what we're determining to be market rates. It's critical to success.
And sharing that information back and forth. Likewise, if they have a question, they reach out to you and you help them in a certain degree. Because at the end of the day, a rising tide raises all ships.
Oh, sure.
Right?
Oh, sure. No, I learned, shout out to Beth Azor, when I took her class, she talked about her shops at Arrowhead and how she was able to constantly increase rents at that shopping center. And she noticed that the adjacent centers ultimately weren't keeping up. And that was driving the value of her space down because she would quote a rent and they'd say, oh, I can go across the street for this rent. So she's done a really good job of really taking control of that market and that corridor and having great relationship with landlords and understand what market is based on what everybody's actually doing.
Right.
So you're right. It's only a benefit in my eyes to keep in touch with other landlords and make sure we're growing rents.
That's awesome. Those are great points. You know, as of late, it seems like Regency has reinvested in a lot of their shopping center assets. You know, Bloomingdale comes to mind right off the bat, which it seems to be a trend in the shopping center REIT sector. You see Kimco, you know, kind of selling some of their assets and investing in some of their stronger properties. Can you talk to us a little bit about that? How you view reinvestment in kind of some of your existing shopping center assets?
Sure. So compared to acquisition, I mean, obviously there's a lot of hands in the pot. Everybody knows cap rates are extremely compressed right now. And, you know, we think we're very well positioned in the markets that we're in. So if we can enhance those properties to create additional value, for us, it makes a ton of sense. And if we do it right, we're seeing a ton of upside. We're able to grow rents and ultimately attract better retailers. But, you know, again, redevelopment isn't easy. You have a lot of challenges that come with that. But again, just, you know, based on our positioning, there's a lot less risk in enhancing that property. We know what we have. We know ultimately where we can go with rents based on market values and what other folks are doing. So we're more comfortable in the redevelopment sector right now than acquiring properties.
Gotcha. And what are some assets that you guys are going through that process with? I know Bloomingdale's one. Are there any others in the state or in your portfolio of 33 that you work on?
Yep, we're doing a Whole Food Center up in Jacksonville. Pablo Plaza off the beach. That's getting redeveloped right now. We added a Petco. Whole Foods is obviously going in, taking a former Office Depot box. You know, facade renovations. We've added an out parcel on the corner. So it's, you know, allowed us to attract some of the best retailers out there that are poking around, and ultimately we were able to enhance the rest of the small shop space. It was primarily local tenancy, which, you know, nothing wrong with local tenancy, but we weren't able to attract any nationals before going into this redevelopment. Bloomingdale, we're doing over here in Brandon, is another great example. I'd say our ceiling for retail was probably Chipotle going into this redevelopment, which ultimately we had. But you had a Walmart anchor that was underperforming. You had a shopping center that had access issues. You know, the intersections weren't signalized. Bloomingdale is very busy. Bell Shoals is very busy. Publix was underperforming. So there were a lot of reasons why this asset wasn't doing well, and we wanted to cure those issues. Now, we knew Walmart was building a super Walmart down the street. So ultimately that allowed us to get a little bit aggressive on a redevelopment plan. And again, underwriting all the current rents and determining, all right, if we bring in a new Publix, if we spend $30 million in the shopping center, what kind of returns can we get, or what kind of rent growth can we achieve? And, you know, we were probably 15 to 16 bucks a square foot going into this deal for average rents in the shopping center for small shop. And I'll tell you, all the deals that we signed post redevelopment, nothing's less than 30 bucks a square foot. So huge increases in rent. And, you know, compound that over time, you know, we're a REIT, so we look for annual rent growth. So we've also got annual rent growth steps in those too. And, you know, yes, those are high rents, and yes, we're probably setting the market over there, but rent's a factor of sales. Our tenants over there are doing extremely well. And
you create some great synergies there too. I mean, you really have different uses that you brought in, a lot of restaurant. I believe on your out parcels you have a couple, I think you have a multi-tenant strip, if I'm not mistaken, that has a restaurant and a lot of service-based uses to bring foot traffic into the center. And then you have your Publix there in addition to other, what's the other concept that you put in there as well?
So Home-Centric is adjacent to the new Publix. And we're backfilling the former Publix with LA Fitness. So we're very cognizant of, you know, understanding we had a traffic flow issue before. LA Fitness, high intensity parking user. So we put First Watch to anchor our out parcel directly in front of LA Fitness. They close at 2:00 in the afternoon. So kind of the highest impact times for LA Fitness in the evening, you're going to have the 3,800 square foot, you know, end cap anchor of our out parcel closed. So it, you know, again, it helped with traffic flow and kind of understanding those dynamics allows us to be successful in these redevelopments.
And this goes into one thought that I had, just what would you say if you had to draw it up on a whiteboard, the ideal shopping center from tenant uses, square footage, building orientation, gross leasable area, out parcels, etc., what would that look like? Would that look similar to what you just went through with Bloomingdale? I mean, you have a fitness-based use, you have your grocer, you have your restaurants, you have all those things. I mean, that just seemed like it seems like the new age retail plaza.
I'd say a strong anchor is where it starts, and we're very comfortable in the grocery sector. So right now, Publix has been a great anchor to do business with, and Bloomingdale Square that we're talking about, we obviously have a Publix there. We were able to bring in an LA Fitness, which is another great national that's had very good success in the Tampa market. But, as far as a layout of the shopping center, obviously you want the strong anchor generally in the center of the shopping center. Then your end cap spaces, you want to be your destination driven tenant. So your food users, your folks that are going to have a patio, they become your front door to the shopping center. We like shopping centers where people come in and see other people having a good time, outside eating, drinking, enjoying themselves. To us, it's a positive. And, again, they kind of become the front door of the project. And then everything in between the anchor and your end cap destination tenants, where you're going to put your impulse tenants, your service users. And that landscape has certainly changed, in the last 5 to 10 years. We're seeing a lot more service, a lot more food, a lot of fast casual QSR operators, a lot less, true retail, I'll call it, but your boutique fashion users, folks like that, for multiple reasons, omni-channel retail, whatever it might be, they've struggled a little bit more in kind of the grocery anchored shopping center stuff.
Right.
So, a lot of service uses, a lot of, impulse kind of food users, your poke bowl concepts, your acai bowl concept, your smoothie concepts. And obviously you want to be complementary to the anchor. So, if you're doing an LA Fitness deal in that shopping center, we recently signed Tropical Smoothie and GNC.
Wow.
Those are uses that are complementary to the LA Fitness customer.
Makes sense.
We're doing, these restorative cryotherapy, IV uses, and they'll take tough space, they'll take elbow space, and they still pay market rents. And again, it's complementary to the LA Fitness. What we try to do is make sure that we have all of your daily drivers in the shopping center. We want you to be able to get your groceries done, work out, maybe grab a bite. With our pediatric, associates, by example, at Bloomingdale Square, you got your pediatrician's office. You can be dropping your child off to get an appointment done. Meantime, you can go take a Pure Barre class. On your way out, you can make sure you're hitting, Publix to grab your groceries. We want the daily drivers that create convenience for all the other players in the shopping center.
That's so like an orchestra playing music together. They just all got to balance out and be good synergies.
Yeah, one-stop shop for lack of a better term.
Yeah, that's great. No, you said that was well put. Can you discuss with us how to manage the process of redeveloping an existing shopping center, which you have a lot of experience with? Coordination with the individual tenants, the timeline. Traditionally, will you knock down the entire building at once? Will you do it in stages to keep portions of the center open?
It's property specific based on what we're looking to accomplish. So Bloomingdale that we have talked about, we had a vacant Walmart box. So that space, we couldn't repurpose it. We were able to keep a piece of it for the home-centric space, but for the most part, Publix requires a new box. So we had to tear that piece down. Now that's on one end of the shopping center, and you obviously have an operating shopping center on the other half where the current Publix is existing. So that was a unique opportunity where we could tear down a building, build a new Publix, because you can't have any downtime when you're working with Publix, right? So the day that they open a new location is the day that they're going to close in the existing location. So we were able to kind of isolate those spaces on one end of the shopping center and tear that down without really impacting the rest of the retailers. We didn't have to close off drive aisles. We didn't have to block visibility or sight lines to their spaces, things like that obviously are key for their performance. Now we have other centers like Regency Square, also in Brandon off 60 and 75, where we're looking to really just modify the storefronts, bring a new appearance to the facade. It's a large brick shopping center.
Okay.
And so we want to do something more kind of modern industrial. And so we're going to be doing all new facades, all new storefronts. And then we also have some access issues in the shopping center. So right now there's a entertainment component, I call it, where the AMC theater is kind of in the back of the shopping center. And then you have your retail component, which is in the front of the shopping center. But there's no drive aisle that connects those two. So if you want to get to AMC from TJ Maxx, you're either walking through the entire body of the center and through a corridor area, or you're getting in your car, driving around to the back of the shopping center.
Interesting.
And it also creates issues during high traffic times, holidays, things like that. There's really only two ways to get out of the shopping center if you're in the retail area. And those both exits are very heavily trafficked. Mm-hmm. So folks get backed up. So we're creating an additional way for folks to not only get to the entertainment component, but also get out of the center. We're adding a drive aisle through that back area of the shopping center. So we're tearing down some architectural features and creating the drive aisle. Now that's a case where, you're paying money to, again, remove these architectural features and add the drive aisle. You're not going to get immediate rent return on that.
Right.
But we think from a long-term standpoint and allowing that traffic to flow through there better, we're ultimately enhancing the shopping center. Also, from an aesthetic standpoint, doing something to the appearance with all the new storefronts.
Sure.
We think will long-term benefit us and allow us to continue to bring in high, Class A retail. And we just had Bath and Body Works, by example, that signed at the shopping center, and they're located in the mall right across the street. So when we can pull mall tenants out of the mall, Ulta's another great example. I mean, they've got, numbers of potential relocation opportunities within the market, but they liked ultimately what we're going to be doing with the redevelopment. We're giving them a new storefront, helping them kind of add their orange awnings and branding, and it's complementary to what they're trying to do.
Sure.
And it allows us to enhance our property. So that's one where, we're not tearing down a building, but we're obviously doing some modifications to common areas. And a lot of that work is going to have to get phased. You're dealing with national retail that have blackout dates.
Phased. Oh, okay. In stages.
In stages.
Right.
Yeah. So by example, we're going to start on the Ulta, about 30% of the shopping center where Ulta exists today. That's going to be the first phase of the shopping center.
Okay.
That's going to get done between August and October.
Okay.
And then we fall into a blackout date with Ulta between November and January, where they don't want any construction getting done during the holiday timeframe.
That's reasonable.
So we'll move to phase 2, which is kind of back towards the entertainment area where we have more localized tenancy, and we can do that during the holiday timeframes. And then once we get out of that blackout period, we'll move to phase 3, which will be the Old Navy portion. And again, you're dealing with blackout periods and restrictive timeframes in which you can actually do construction.
Is that in their lease agreement? Blackout periods says you cannot do anything, any renovations of the center during this period of time, because this is a high traffic. These are high volume times for our stores. It makes sense. I just didn't. That's in some of these agreements.
Correct. Yep. Their agreements govern when you can do construction, and it's to not impact again the sight lines, the access roads, things like that.
Yeah. Cool. And then talking about the facade, just curious, like, do you get to have a say in kind of what it might look like, or do they ask your opinion? Like, who designs that stuff? That's one of the hardest things to do. We have a center on Clearwater Beach, and just even picking paint color is a difficult thing.
Sure. So we have some great architects that we work with. BDG, by example, API that helped us out at Bloomingdale. So API did Bloomingdale, and BDG is assisting us at Regency Square.
Okay.
And they really lay it out for you and give you several ideas, and you start going in one direction. And ultimately, they do ask for our say and what we think of this color versus that color. But we really rely on the experts, and that's what those guys do. And
this is a renovation. I mean, this is going to be set in stone for the next. This investment's going to go the next 30 years with that look. You know what I mean? So that's going to be the new age shopping center look.
Sure.
Which is awesome.
Yeah.
And then just talking about the roof, say you have an older plaza that you own and you needed to do the roof, how do you work through that process? How do you work through that process with tenants? I'm assuming you do that in stages. I just was curious to see what your process was for that.
Yeah, that's also phased. So we'll start with an anchor box, by example, and then kind of work our way down the center. But a roof really doesn't have a major impact on the tenants. We're able to kind of do that, during on or off hours.
What if they're pulling the whole thing off though, and putting a brand new roofing system? Yeah,
that's a little bit more of an impact, and obviously you have to work with the retailer to find out, is noise going to be an impact? Where you've got a very loud store like Publix, it's much less of an impact than when you've got a Massage Envy type tenant. So we're cognizant of that, and we make sure we work with them. If we're doing Massage Envy space, we're probably starting after 8 o'clock and maybe starting at 4 or 5 o'clock in the morning to get it done, obviously in their off hours.
Gotcha. It just brought out when I just thought of this, but when you build out spaces, say you put like an Orange Theory next to maybe like a doctor's office, the Orange Theories are going to be, yelling and loud and working out, and the doctor's office wants quiet. There's some material that I know of that they put actually in the wall systems. Do you know about that? Have you ever heard of that? You use that?
Yeah, sound attenuation's been tricky. And we've really been exploring a lot of options. What we have found to be the best is creating space. So when you can create air pockets. So, by example, demising walls. Instead of having a single wall down the center that the vibration can pass through, we essentially create 2 demising walls with a 6-inch gap in between. And then there's also other things that you can use to dampen the vibration impact. The sound travels through the vibrations.
Right.
Ultimately.
Yeah.
You can cut the slab. You can ultimately separate the roof lines, things like that. But where we've seen, the biggest benefit is really creating an air gap between the two spaces. And, your demising wall is 6 to 8 inches thicker than it generally would be.
Right.
So that takes away GLA and, it ultimately impacts the center. But we're going down that road because we've had those issues.
Right.
I mean, there's a shopping center in Carrollwood, the Village Center, where we've got Orange Theory Fitness right next to a user that offers massages. And just that, they would hear, and it's great. Orange Theory does a really good business over there, but they would hear all the speakers and all the noise and the bass and all the things that you'd expect when you go do high intensity interval training.
Sure.
It easily passed through the wall. And frankly, we didn't anticipate that.
Right.
So there was a big struggle in the beginning. At first, we just cut the slab and still they would get the vibrations. And then we separated the wall and it got a little bit better. And then we had some other dampening materials, might be the product that you're talking about. We got there eventually, but it's been an ongoing learning curve to try to figure that out.
That's the last thing you want when you go to get a massage. You're hearing, let's go faster, 30 more seconds.
But it's also, the tenants have to take some responsibility in this too. When you're coming into a retail setting, quiet enjoyment only goes so far. You have to have an understanding that there are fitness users. I mean, there are restaurant users. Yes, they can keep the space within their noise within their space, but ultimately it's not going to be a perfectly silent space. And so, if you are a massage user, if you are an insurance office, and you really need to create that isolated space and you can't have any sound intrusion, we're asking those tenants to take proactive steps to do sound isolation as well. Just because a retail environment these days is no longer silent. It's not an office. Right.
And the gentleman that I spoke with, he owns a couple centers and he's actually Tampa based and he's involved with ICSC and things like that. And when we were having conversations, he says, it's best if you do this during construction. But how often or not are you doing that during construction? Because you might not have those uses next to each other then, but they might be in the future. And then you got to come back in and retrofit out the demising wall. And it starts getting pricey when you start looking at it like that. I mean, it's best to put it in during the construction period if you can. But 9 times out of 10, you can't because it might be a future use down the line.
Yeah.
From an operating standpoint, from an expense standpoint, triple net expenses, right? I mean, that triple net leases, all your centers are triple net. I mean, that's a cost that the tenant pays, and it's a triple net expenses are a pass through of all the operating expenses of the property based upon a pro rata share of the amount of gross leasable area that individual tenant leases of the entire shopping center, more or less. What are some strategies that you use in order to keep triple net expenses down? I know in your properties you must have some economies of scale with vendors, insurance policies, I'm sure, across your entire portfolio, which is helpful. What are some things that you see or strategies you use?
We're constantly shopping. Whether it's landscaping to painting to whatever common area maintenance that we're paying for, we're constantly shopping. Every year we're refreshing our quotes. We're making sure that we're getting the best deal. Fortunately, we've been able to leverage the size of our portfolio to get these national vendors and national contracts, and we're able to kind of pass those savings through to our tenants, to try to minimally impact CAM as much as possible. Obviously, real estate taxes are a fixed cost. We can't control those things. Insurance, constantly shopping that. We shop that internationally. And again, it's to try to bring the best rate and ultimately leverage the size of our portfolio.
Cool. How do you view, I'm talking about leases, how do you view lease guarantees between a corporate client, corporate tenant, corporate guarantee versus, more of a personal guarantee, letters of credit, and the differences from a national retailer to a more local mom and pop regional tenant? How do you approach and view lease guarantees?
Again, as a REIT, we have to project incomes generally 12 months out. So a guarantee is absolutely critical for us. There are a lot of national retailers, your Starbucks of the world, that you're getting the corporate guarantee, but you're getting it from an entity that has lots of assets. That's generally not the case for these franchise concepts. A local juice bar that's expanding, they might have 3 or 4 locations. We cannot take a corporate guarantee generally from those type operators, just because again, there's a little bit of risk to operation, and we can't secure our site based on, what's generally a newer concept. So we do require personal guarantees on the majority of deals we do.
Right.
Again, with the exception of these kind of nationals that have very large entities that we're very comfortable, securing our leases. But, so long as we have, generally we look for the initial term to be fully guaranteed. Once the initial term burns off, we sometimes are okay moving to a rolling guarantee. A lot of that has to do with our comfortability around the concept. Is it tested? Is it proven? How long has it operated in this market? And, what do their sales look like? And a lot of times we'll ask for a full term guarantee on initial terms and option periods. And then as we get further down the road, if they need to minimize exposure and the tenant's operating, phenomenally, doing really well, sales continue to grow, sometimes we'll agree to limit that, in option periods or things like that. But for the most part, we do require full-term guarantees.
What is a rolling guarantee, if you can just explain?
Yeah, so if we're doing a 10-year initial term, by example, moving to a 12-month rolling guarantee, that means the entire 10 years are fully guaranteed. Now, once you get into that 11th year or an option period extension, whatever it might be, that 12 months is constantly rolling. So if you default at any time within the first 4 years, you're paying a full 12 months. If you default between years 4 and 5 of that term, obviously it's reduced based on whatever's remaining in that period. But the 12-month rolling guarantee is applicable to the first 4 years of any extension, and it continues to roll. So if the term's guaranteed, and then after the initial term and the option period, then you start looking at a full 12 months worth of rent. Correct.
Okay.
Yep. Until that option period burns off. And talk about letter of credits. Do you do letter of credits on your deals? Have you done them in the past? I can only think of 2 where we had to take in letters of credit, and it was more to qualify a tenant that didn't have residency in the country. Okay. Try to overcome some of those issues, maybe a credit issue, something like that. Yes, there's lots of reasons why folks, have struggled financially in the past. Bankruptcy could be another concept, could be divorce. There's lots of reasons why ultimately people have some red flags on, their financial history, and we're able to overcome that with some other things like letter of credit, but it's not something we generally do. And you know what, Brittany Morskowski, with who was formerly with Colliers, now with BTI Partners, she told me when she would vet through tenants, a lot of times she had them do an initial intake form and kind of talk about your business, talk about your business plan, what you're trying to do, talk about all the other locations you own, and then let's talk about your assets. What do you have? You know what I mean? Just so that it has an initial intake form, so you can kind of base the conversation moving forward. And I thought that was interesting. I'm sure you do something like that as well, I'm assuming. Yeah, we have a financial package that we send out with our proposals. And really, before I can respond to that proposal, once the tenant's responded, I need to see the financials, because that drives a lot of decisions that we're making.
Sure. And then how comfortable do you get on some of these things with the investment dollars into the space? What if you have a tenant that's like, hey, we want to sign a 10-year lease, we only want to guarantee, I know you need the whole full initial term. I'm just talking hypothetically from your experience. 10-year term, 2 or 3 years, they're willing to guarantee the lease, but they're spending $1 million in the space. How does that make you feel from the landlord's point of view?
So we love it when tenants invest in their own business, and we generally keep the cash flow or what we're willing to put into a deal low. And in turn, we keep the rent low or at market and look for annual growth. We do require the tenant invest in their business. We're not a TI heavy landlord.
Right.
We're also not merchant developers. We're long-term holders. So we're looking to ultimately get a return on the investment that we're making. And, we generally will give 1 year's worth of rent in tenant improvement allowance, kind of as a rule of thumb. Yeah. But, for the most part, we do require the tenants invest in their business, and, we're not looking to sell the value of that rent. So we're not looking to buy up rents. It's something that we just don't do, because we're not selling based on a compressed cap rate to try to get a return. We're holding this long term. So we'd rather, again, given that we're a REIT and we're valued by rent growth, keep the rent low and sustainable, be able to grow that rent, and have the tenant invest in their business.
That's a great point. I mean, putting forth a bunch of money, buying up the rent, the tenant goes, they don't make it in their business or whatever. Then you have to replace that $45 rent with a market rent that might be a $25 rent.
Right.
Yeah. I want to talk to you about use restrictions. That's been an interesting conversation I've had as of late, because a lot of these shopping centers are older assets with tenants that have had long, crazy leases since, 1950s or whatever. Not talking about this directly, but just for example, the Kmart's of the world with all these crazy different options, and they have the original lease that was negotiated way back when. Can we talk about use restrictions? I know back in the day, many of the national retailers had an extensive list of uses that were once prohibited. As time has gone on, many of these retailers have softened up to the idea of letting certain uses occupy space, medical, fitness, things of that nature at the shopping center. I think that this has been a function of the evolution and change of retail over the last 20 years, with restaurant-based, service-based, experiential uses driving the future of brick and mortar. Do you have any stories that you can share?
Yeah, so you're right. I do agree that it's related to kind of the evolution of who we're seeing being successful in these retail storefronts. And again, we're primarily grocery anchored. We are seeing a shift in mindset, and we're able to obtain waivers frequently from our anchors. Not all anchors have made this shift. There are a few that I'm not going to name, but you're right. We're starting to see less resistance to entertainment, food, and fitness concepts because they're huge drivers to the shopping center.
Right.
The reality is anchors don't want vacant shopping centers. They also don't want the nuisance uses. So we're fortunately in a position that we have very strong relationships with the anchors that we do business with. Mm-hmm. And I think there's a level of trust there as to the quality of tenancy that we're going to do. And if we're bringing a waiver to the table and we're saying, look, this is restricted, but I think unintentionally. I think they really have a great impact on the shopping center. Right. There's some vague language in some of these leases that says, you can't do gymnasiums or health clubs.
Right.
Well, what's a gymnasium? What's a health club? Is Orange Theory Fitness a gymnasium? Are they a health club? So ultimately, we'll go in for a waiver related to that language because we know Orange Theory Fitness does really well in Publix anchored shopping centers or grocery anchored shopping centers, and we know ultimately those are the same customers that these anchors or Publix are looking for.
Right.
It brings that female, that family-based customer, which just benefits all of our tenants. So a lot of that language is old. A lot of these leases are older, but again, we have no problem going in for waivers, and most anchors are very receptive to accepting a lot of these waiver agreements. Again, we're able to show the benefit to all the small shop, including the anchor.
Yeah, the lease is a living, breathing organism. It changes and evolves over time. Yeah, it's an obligation, but like things in this nature, they used to, relating to the example you give, they used to not want health, fitness. They said, no way, we don't want them eating up the parking lot. Now, quite frankly, in certain situations, they're begging them to come because they want the foot traffic to the center, because everything's omni-channel and a lot of people are buying certain products online. They want to create an experience, create that synergy, have all the uses kind of feed off of each other. So they're, I'm seeing them get a little bit more flexible and kind of in that sense.
Yeah, there's still sensitivity related to parking. That's probably the biggest fight that we have when we're trying to get some of these uses ultimately approved is the impact of parking. Mm-hmm. Obviously, convenience is huge in today's day and age, and these fitness users, they do use more parking, and that's where you have to get creative with positioning within shopping centers. You don't put your Orange Theory Fitness generally next to the front door of Publix,
right? Or
you don't come to Publix with a waiver looking to put a restaurant right next to their front door. Again, those are high intensity parking users.
Right.
You're generally going more for, if they have an educational restriction, you're looking to a Kumon, or you're looking to do an educational tutoring facility, you put that next to the front door and you're more likely to get a waiver approved. And it really, you just have to play with positioning within the shopping center.
And then like in those situations, I'm just curious, have you ever dealt with, an Orange Series coming into a shopping center or uses coming into a shopping center and they might be reluctant to approve that use, but then you say, listen, we'll do a traffic study and show you, maybe how much more traffic that they may or may not generate from that particular use here at that property to make them maybe feel comfortable. Has that ever been something that you've done?
Usually we don't go that far, and it's hard to really calculate traffic within the shopping center. Technology, it's gone a long way, and we're able to kind of geofence properties.
That's
to
cool.
Compare them to other properties and see kind of that impact and how many visits we're getting on a daily basis versus another center.
That's better than a traditional traffic study because that's real-time analytics.
But we don't have anything yet that allows us to look at our parking lot and say, between By example, the first watch that we talked about earlier in front of LA Fitness. I don't have anything that I could show LA Fitness that the first watch customer ultimately doesn't, not using that space after 2 o'clock, although they close at that time. We just don't have anything that can really hone in on our parking lots and say, where people are parking at different times of the day.
I wrote a blog post about this, and it's interesting. I forget the name of the actual company that does this, but there's a group out there that actually looks at parking lots of like Target boxes, essentially in order to predict future revenue growth, to see if it's a good bet from a stock market standpoint to invest in the stock. You know what I mean? To say, hey, listen, they're having a ton of traffic here at their brick and mortar. We think that their next quarter is going to be great. There's actually companies doing that now. I thought that was interesting kind of point to make.
We're doing something. There's a company that we use called Placer AI, and it allows us to geofence other assets other than our own.
And what's geofencing, just for the people that don't know?
Basically, you're putting a box around an asset, freestanding, shopping center, whatever that is, and then it will tell you, based on the area that you're highlighting, how many folks a day are coming in there, how long they're staying, where they're coming from, where they're going to. You have technology on your cell phone, various apps that intentionally or unintentionally, you've agreed to allow them to track you. And this information is sold to companies like Placer AI, and they're able to say, Jeff, if you spend 90% of your time between 9 p.m. and 6 a.m. in one location, that's your home. If you're spending 90% of your time between 8 a.m. and 4 p.m. in one location, that's likely where you work. You see it on your phone. You pick up your phone on your way home and it says you're 22 minutes from home. How does it know you're going home?
Exactly.
Well, it's able to kind of track those time frames, and ultimately that converts into data that companies like Placer are able to use. They're able to tell me when I'm evaluating, looking at TJX companies, by example, if I want to put a Marshall's in a shopping center and they say, we're not sure if, that market would ultimately pull from an existing store, we're able to look at that existing store, see where all the customers are coming from, and find the gaps in which they're not pulling their customer from, be able to make a case and say, no, look, this is where the customers are coming from for this shopping center. Your adjacent, space that you're in further down the road, you're pulling from the east. You're not pulling anybody from the west. So you've got this whole pocket of folks that you're not reaching. And by putting something in our shopping center, you'll be able to achieve that. But it's also helped us a lot too. We talked about this earlier. A lot of sales are going online, yet retailers are maintaining storefronts. So when we're coming up for renewals and things like that, we might not capture all those sales in the sales reports that we're getting. So a retailer might show us that they're doing $2 million out of the store, which they're only required to report what they're doing out of the store. They might have a huge online platform. I mean, Staples, by example, we've got a Regency Square. So I look at their sales, and I'm sure there is 40 to 50% of their sales that are being done online, and maybe they're just picking the product up in the store that I'm not picking up on those sales
from your brick and mortar
reports that I'm getting.
Right.
So we're able to use this Placer data. So as we're coming up to a renewal, and I'm just using Staples as an example, we're able to look at our Staples, pull the other 6 or 8 Staples in the market, and determine whether or not we have more traffic coming into our Staples than any other box in the shop, the general market. So we're able to kind of determine whether or not it's the highest performing, kind of average performing, or even low performing.
Where it ranks.
Yeah. And that's based on actual traffic counts and folks coming to the space. So it kind of allows us to have, a little bit more insight as to how they're performing over and beyond the sales, because, again, a lot of these things are being done online, and you're just not capturing that in traditional sales reporting.
That data, that technology is so valuable. I mean, even when you look at a center and you look at a heat map and you look at all the customers going into certain locations, and you look at a lot not going into a certain location, then you see the sales report. I mean, it's just great information to kind of foresee what might happen in the future, or maybe how to rearrange uses or add certain tenants to certain centers, or maybe look at your portfolio and see, wow, this use does really good over there. Maybe we should find a use that, maybe we should find a tenant that has that same use for this center.
Absolutely.
And so I love stuff like that. I would love to learn more about Placer AI. I know it's a great program. I've heard great things about it. I know it's an expensive subscription-based program, but I've heard it's very valuable. And at the end of the day, real estate, it's a gut feeling. You have to have a comfortable feeling in order to do a real estate decision, but data helps make that decision. It shouldn't be an end all be all, in my opinion.
Sure.
Back in the day, I talked with Bob Bose, and I used to work for Bose Development, and I talked to him because they did a lot in the Family Dollar program, and they had these, the real estate committee for Family Dollar, and they would put a Latin long pin on a site, and they would generate a future hypothetical sales projection, which I think that the store would do that amount of sales at that location in that market, 1.5 million, let's just say. They would back into all their real estate, how much they could afford to pay for the real estate based upon that hypothetical sales projection. And I asked Bob, I said, back in the day when you worked for CVS, what exactly, how did you, or I'm sorry, Eckerd's, when you worked for Eckerd's, how did you all make real estate decisions? Did you have a real estate committee? I mean, how sophisticated was it? He says, Jeff, we just got in the car, drove it. If we liked the site, we liked the market, we all had good feelings about it, we would do the deal. That was our approval process. There was no, hypothetical sales projections and things of that nature. It was just a gut instinct. We had a good gut about the deal. And so it's just interesting to see how things have changed technology wise.
Yeah. Your market knowledge is ultimately your product knowledge, right? And just having this technology in place gives us an extra layer of information to kind of evaluate our decisions on.
Yeah. So, well, Marc, I appreciate your time. This was great to do this podcast. I respect you. I value you. You're one of the best people in the retail leasing world that I know. One of my best contacts, and I think that you're doing an amazing job growing your career. You're very intelligent on it, and I can't think of anyone. You're definitely at the top of the list as it relates to retail leasing. So keep it up, and I look forward to building a relationship with you. I appreciate you being here on this podcast.
Same here, Jeff. Thanks for having me.